Hello, welcome to the walkthrough video for Chapter 4, where we're going to look at a special order decision and a make or buy slash outsourcing decision. And these problems can help you with your practice problems. All right, so we have this company and we see a budgeted income statement, and the company produces wall mounts for flat panel television sets. Assume the forecasted income statement for next year is as follows. Of the production costs and selling expenses, a portion of these costs are fixed. So notice that this is not a contribution margin income statement. This is a gross margin income statement. So buried in cost of goods sold and selling expenses are variable costs and fixed costs. When we have to do a special order decision, which I think this one is, we really need to take into consideration those items separately. So they're giving me this information because I'm going to have to pull something out. So let's see. Let's keep going. We have the company receiving a special order from a hospital supply company offering to buy 10,000 wall mounts for $15. If it accepts the order, there will be no additional fixed selling expenses, and there is currently sufficient excess capacity to fill the order. That's good to know. The company's sales manager argues for rejecting the order because we are not in the business of paying $19 to make a product to sell for $15. That's quite interesting that he can make that assumption that quickly without knowing which costs are variable and which costs are fixed. But let's keep going. Do you think the company should accept the order, and should the decision be based only on the profitability of the sale, or are there other issues that the company should consider? All right. The first thing that we need to take into consideration is the current production volume. And I need to know that because I have to calculate the variable costs and the fixed costs. So the first thing that I'm going to do is find the current production volume, which it sounds really fancy, but I'm just trying to figure out how many units I sold. I had revenue of 5.6 million, and that price per unit, selling price per unit was $28. So that's exactly what we're going to do. We're going to take those two components to help me find how many units I'm actually selling right now. So that's 5.6 million divided by $28. And then let me actually do that calculation, 5.6 million. All right, so we have 200,000 units. Back here and make this look nicer. And we'll say that equals. Now, let me add a comma here. And I don't need any pennies. Now, you're probably thinking, why do I need this again? It doesn't make sense. Well, in order to determine whether or not I should take on this special order, I have to determine the costs of the special order. The costs of the special order are variable and fixed. Now, in looking at the information, my fixed costs may be unchanged, but I need to pull out from cost of goods sold and selling expenses my variable costs. That's where I really want to start. Let's see. If it accepts the order, there will be no additional fixed selling expenses. Okay, so that's good to know. But let's find our variable costs for making the wall mounts. So for our variable costs, I have 3.8 million. That's total. Of that 3.8 million, 1,520,000 is fixed. Now I'm going to take that remaining variable cost and I'm going to divide it by the total number of units we just found, and that's going to give me the variable costs per unit. throw that here. Bear with me, trying to make everything line up. So 3.8 million minus 1,520,000, all divided by 200,000 units, gives me a variable rate of $11.40. So I do want to make this dollars, and I'm going to call this my variable production costs. Now, I also need my variable selling costs, and I have to go back to the original problem because I cannot see it. There we go. My variable selling costs are not explicitly given to me. It's showing here as $5 per unit, but I know that includes some fixed costs, and they told me that my fixed costs wouldn't change for my selling expenses. So I need to make sure that I subtract that out. So we're going to take that 1 million and we're going to subtract this 750,000 that they told me represented fixed costs. And all of that will get divided by 200,000 units because I want to know this cost per unit. And that's going to be my variable selling costs. All right, so now let's actually do it. 1 million minus 750,000, all divided by 200,000. And I have a magic number in my head of $1.25, and it better be that. We don't know. Good, it is $1.25. Now, I really needed my variable cost so that I could compute my contribution margin because what I need to know is the additional increase in profits that I could possibly have by taking on this special order. So the special order would sell at a price of $15. Now, initially, I get why the manager is upset. They're saying, oh, it cost us 19 for us to make it. But technically, we need to look at this in terms of variable costs and fixed costs because the fixed costs are always going to be there whether we take on this order or not. We still have to cover it. We want to look at the additional profits. That's why we focus on the contribution margin. So now we're going to take that selling price of 15 and we're going to subtract out our variable cost of $11.40 and $1.25. And that's going to give us our contribution margin per unit. We're then going to take all of that and multiply that by the number of units that we would sell from this special order. So first, let's do this math. Let's do the 15 minus the 1140 minus the $1.25. And this represents my contribution margin. I'm going to make that a dollar. Oh, not a comma, dollar. And then we're going to take that same 235 and we're going to multiply it times the 10,000 units from the special order. And I know you've done this in your head. You've added your zeros already. You know it's 23,500. So by accepting this special order, we could have profits increase by $23,500. So yes, I know we're not in the business of making a product for 19 and then selling it for 15. It doesn't make any sense. But that's because we're looking at some irrelevant costs in the decision. Our fixed costs end up being irrelevant because they will still be there. We don't have to take them into consideration. we really need to focus on our contribution margin. And we'll have an increase in sales. So we'll get an additional $15. We'll also have an increase in costs. That's why we focus on that contribution margin. So we end up seeing an increase in profits of 23,500. Increase in profits. So we should accept the special order. Now, the last question on here says, oh, should the decision only be based on the profitability of the sale, or are there other issues they should consider? Absolutely consider other issues. And one of the main issues is whether or not we're going to make our regular customers unhappy. Happiness of our regular customers. Will management be too focused on this special order that they don't have enough time to meet the needs of the current customer base? So we always want to take our current customer into consideration. It's great. We have excess capacity to do this. We could get additional profits, but our current customers may be upset that you can't meet their needs and you're not focused on them as management. And they may be upset that someone else gets these wall mounts at a cheaper price. So customers could also be upset, regular customers. The cheaper price for other customers. So if you think of yourself as a customer, if you hear that someone else can get an iPhone for $50 and you have to pay, I don't know what it is, $500, and you're probably going to be upset about that. All right, that takes care of the special order problem. You want to make sure that you are only taking into consideration those relevant costs, and that contribution margin is what is relevant. Now, let's look at a make or buy or outsourcing decision. This time we have a printer company, Epson, producing color cartridges for inkjet printers. Suppose the cartridges are sold to mail order distributors for $5.20 each. Total fixed costs per year are $342,000. Variable costs per unit are $1.85 for materials, 10 cents for labor, and 30 cents for factory overhead. Assume the current annual production and sales volume is 180,000 and annual capacity is 220,000 units. So what's going on here? So we need to determine the effect of the following situation on annual profit. So now we have a Guatemalan manufacturer has offered a 1-year contract to supply ink for the cartridges, including the shipping costs, at a cost of $1.25 per unit. Oh, that's nice. If the company accepts the offer, it will be able to reduce variable manufacturing costs by 50% and rent some of the factory space. Ooh, that means we have some opportunity costs here. They can rent some of the factory space to another company for $1,100 per month for 12 months. So let's go ahead and set up a nice table that we can use to help us analyze this make or buy decision. So another form of a differential analysis that won't take us too long to do. All right. Ignore me as I resize columns as I try to make this look halfway decent so that when you go back and look at it later on, it actually does make sense. So with this outsourcing decision, we are going to compare the cost to make these color cartridges with the costs to buy. Now, just because it's right out in front of my face immediately, it's easier for me to focus on the cost to buy it first. Because with the cost to make, I got to take into consideration all of my variable costs, and there are multiple variable costs. So let's deal with the cost to buy first. Now, of course, if I choose to make it, I'm not going to have any cost to buy. So it's zero. But if I choose to purchase it, then I'm paying $1.25. And annual production is 180,000 units. So I need to take that $1.25, $1.25, and I'm going to multiply that by the 180,000 units. Ahead and format these. Now we're going to compare that cost to buy with the cost to make. Now, for the cost to make, I need to take into consideration all of my variable costs. And for my variable cost, I have $1.85 for materials, 10 cents for labor, and 30 cents for factory overhead. So let's throw those numbers into our spreadsheet. So I have my 185. And if it will let me type, there we go. I have my 185 plus my 10 cents plus my 30 cents. And all of that will be multiplied by that same 180,000 units. Now, that's if I make it. If I buy it, then my variable costs, I won't be able to eliminate all of them, but my variable costs will be reduced by 50%. That's what my special scenario said down here. We can reduce our variable manufacturing costs by 50%. So in this case, I would just take the 405 and multiply it by half, multiply by 0.5. Same thing. And we get the 202,500. So in the examples that we did in the slides, we could eliminate all of the variable costs. And it doesn't always work that way. We can reduce half of our variable costs here. Now, normally we would be done, but if we choose to buy it, we can rent some of that factory space to another company for $1,100 per month. That is an opportunity cost. And that opportunity cost actually increases my cost to make it because I'm foregoing this amount if I choose to make it rather than buying it. So I take my 1,100 and I multiply it times the 12 months. And we get the 13,200. So if we choose to make it, let's add up our numbers and see how much it'll cost us. Now, if we choose to buy it, so this time there's a net decrease in profits. So it's better to not outsource this time. Take that cost to make, subtract out that cost to buy, and we see that our profits actually decrease. So in this case, we would continue to make the ink or the color cartridges. I'm sure we still have 50% of the cost because we still have to make the black cartridges for our inkjet printers. All right, that was a great example of outsourcing. Remember, you want to take into consideration the costs that will differ between our alternatives. And typically when it comes to fixed costs, if they're not changing, those fixed costs are going to be there regardless of whether we make it or buy it. In some cases, we can reduce it. In some cases, we cannot. But what we really need to focus on would be the variable costs, the additional cost that we'd have to pay out if we chose to purchase it from somewhere else, and that opportunity cost. All right, I hope this helps you as you are working on your case study as well as your problems. I appreciate your time and attention, and I hope you have a wonderful day.